Hello and welcome to this brand new edition of Commodity Champions. I'm Manisha Gupta. A slew of rate hikes by the US Federal Reserve has exerted pressure on central banks around the world to follow suit and hike rates in order to counter the rising inflation and a stronger dollar. As per a Financial Times report, 55 central banks made 62 policy rate increases of at least 50 basis points in April, May and June. The dollar index is currently at a 20-year highs, which has put a renewed pressure on oil and other key commodities. Oil prices so far have been whipsawed between concerns over supply due to Western sanctions on Russia and worries the central bank's efforts to tame inflation may trigger a recession, impacting demand. Joining me now to take this discussion forward is Paul Hickin, director at S&P Global Platts. Paul, hi, thank you so much for joining us on CNBC TV 18. It clearly has been one whirlwind that we've seen come in for the crude oil prices, and I would say second year of doing so as well. We're back at about $100 a barrel, but the kind of concerns that we see from Russia, from Gazprom, that really seems to be making headlines right now. How would you look at, first of all, the gas situation, where we are looking at strong demand, but lower availability and even lesser affordability?
Yeah, the gas market is one that's extremely concerning right now, given that the issues around Nord Stream and as well. And we were on a situation where gas storage was being filled up across Europe, because that's the big key. Next, not right now so much as what happens now for winter time, because when winter hits, if we have a cold winter, especially after now this hot summer, if we have this a cold winter in Europe, puts a lot of pressure on gas demand when storage if storage isn't filled up, and then you're requiring on LNG demand, the fluid part of the market, and that will be required in Asia at that point, and there'll be a real fight over those LNG barrels, and that's what the pressure is, to get enough gas into storage now, if those political concerns can be assuaged, and to make sure those gas storage is filled in Europe ahead of winter.
And it's ahead of the winter, that's being one point, but the other clearly is the kind of air conditioning demand that we're seeing from UK and US and various other countries as well. So whether it's now or for winters, the gas demand seems pretty on the higher side. What is your sense on how you look at the supplies? Because whether it's about Russia or the US inventories, which are below 5-year average, or the fact that we have seen concerns at Freeport, Texas LNG facility. So everywhere that you look, there are supply concerns. How do you read that? And what's your sense on the premium of all of that on prices?
Well, I think the main thing right now is that storage is still below. It's still, but at the same time, it has been on track to build that storage in place. It's so fragile. We've been behind for a couple of years now, and when you look at where extra electricity demand can come from, for example, wind and solar, it's still very variable demand. It still makes up only a small part of that energy mix, and so there is still a huge reliance on gas. Hence why it's Europe to wean itself off of Russia gas is a very difficult thing to do. While you see in the oil side that is something that's even then is being taken over several months to try and change the way Europe buys its oil from, and you've seen that where the way the oil flows have changed in the sense that China and India have been buying up a lot more of Russia crude, and Europe has been buying a lot more of US and Norwegian crude, and some more from the Middle East.
So, Paul, let's take a look at the case study then. If Gazprom, or rather Nord Stream pipeline, does not open on 21st of July, there also is one of force majeures that Gazprom has declared yesterday. If it does not open, what are the kind of prices that we're looking at for gas?
Well, this is we're into real shock and awe. We're in shock and awe territory again. If that was the case, I think we've already seen triple-digit gas prices, and that is certainly a risk again if a deal can't be arranged, if it breaks down in terms of an arrangement. But what could well happen? There's many scenarios that could play out here. It's very difficult to know, but at the same time, what we should remember in these scenarios is that security of supply and security of demand are both important here. You lose suppliers. You know, if supply is not given to Europe, it creates its own dynamic way down the line in terms of political and economic consequences. So I think you've got to look at energy security from both sides and not just the supply angle. And that is something to bear in mind when July the 21st hits.
Absolutely. I absolutely take that point. And the other thing really would be on the 27th of July when you have the US Fed meeting. So if it's a 75 basis point of a rate hike, if it is 100, if it is 50, playing all of those scenarios, how do you look at the energy markets, the crude oil prices reacting?
Yeah, you've seen the oil markets already reacting in the last few weeks, especially. It's almost been catching up in terms of demand destruction fears, in terms of these inflationary concerns, and the oil market's been so tight, like we've talked about with the gas market. It's the energy markets have been trading off their own balances because the markets have been so tight. Oil has got low stocks as well. It's got OPEC Plus, and OPEC has got historically low spare capacity. Balances are very thin, and yet what we're also seeing is that the fears about Russia supply have not translated into actually that much of lost barrels because China and India have been taking them, and but we are starting to see that the demand destruction fears are being priced into the market, into the oil prices right now, and that is certainly something that will cause extra volatility. Whether we're going to see prices drop below that psychological $100 barrel for a sustained amount of time, that really depends on those fears around economic concerns and recessionary concerns. Because at the moment, still a lot of the forecasts, a lot of analysts are still projecting some kind of growth in demand and GDP for at least this year and potentially next. But certainly the market is on red alert around those recessionary and recessionary concerns, and that is certainly feeding into those concerns. But at the same time, you've got to remember at the same time that oil supplies are still very tight. And if hurricane season, at the same time, we're in hurricane season right now, and September in the US is a key time to watch because that could blow everything off course, literally and metaphorically, because it could hit infrastructure and again cause outages if those risks translate. So there's a lot of risk for the market to ponder on both sides of the equation.
Absolutely. And this is the first time ever that I've heard so many people, really put out helplessness, saying that you really don't know what side market will go because there's just so much playing in right now. Paul, also, so what is your range now for this quarter? I mean, I understand it's, earlier we would talk about the whole year and then people started breaking it to the first half and the second half. And now it's quarter-wise that you're moving ahead because there is just so much to digest into. So when you look at this quarter, what's your sense on what range would we see in case of gas and crude oil?
Well, I think for oil, you're still looking at realistically $100 barrel is an anchor, and it's still likely balances could still well trade above that $100 oil mark. In terms of ranges, all bets are off in the sense of volatility in the market has become such a strong feature. You see that with certain analyst forecasts. We've seen in recent times, $60 a barrel oil forecast and $200 plus oil forecasts. It's kind of crazy right now in terms of even where analysts are seeing prices go, and it depends on which range and certain these tipping points we're seeing. Like I said, with you've got US hurricane season now. You've still got tight supply with OPEC plus. You saw with it's at historically low levels, with only capacity in Saudi Arabia and UAE really to give any extra barrels come there. But at the same time, you've got those recessionary concerns as well. So it's really on a knife edge. But at the same time, I would say $100 a barrel is kind of somewhere where the market is still, it's kind of, the oil market is kind of gravitated towards. And I think it would take a big event or big change in psychology for that to be shifted. The same with, and you look about the gas market at the same time, we've seen triple gas prices triple. It could well happen again. There's certainly a risk scenario of that happening, but more likely is that things will bed down, and that gas prices are starting to get onto some kind of a little bit more stable range right now, where it is right now.
Fair point. So, one more thing. How are you looking at, we understand there are supply concerns here, but this is a market that is basically watching the macro. And on the other side, demand concerns is what is playing up as well. The Chinese demand has been on the weaker side. Europe demand, if it gets into recession, the markets believe that would be the first one to get into recession with the kind of energy concerns it has. What's your demand growth scenario that you look for the second half of this year?
Well, that's the other good question, because China is a little bit of a wild card in a sense. We've been talking about China recovering from COVID lockdowns and that extra 2 million barrels a day of extra Chinese demand coming on, but it hasn't quite materialized. Again, it's continuing to wait as the economic concerns come down. But at the same time, I think you look at where oil demand growth is for demand growth for oil, it's still most forecasts are seeing it's still above the 2 million barrels a day for the year range right now, and that's partly reflects there is still some confidence in China coming back, but at the same time that could well be blown off course, because you've got to remember this. This is the challenge for economic forecasting, is that it's often based on historical data, and when you're going into a bit of a downturn, and especially where interest rates are getting higher, it catches the market out, and that's why we've seen such a quick move to try to price in some of these risks.
Absolutely. Well, yes, there is just so much uncertainty, but thank you for making sense of most of it. Paul Hickin, thank you so much for joining us. And with that, it's time for a short break. But coming up is Philip Newman of Metal Focus. He joins us on the other side to talk all things about precious metals.